Hello sir, my name is Yogesh Wagila. Today and my group is presenting the Financial Management Assessment 3. Our group number is 16. I start with the introduction. Business valuation is essential for firms and well as present and the potential investor of the company. Various share value methods will be discussed in this study. The L technique fair value method, discontinued cash flow method, block value method, and market capitalization. Will cover is the research. Additional to molecular Miller analytic hypothesis be covered in this report. The capital budget analysis of the supply data is also shown in this report. Now the second is the intrinsic value. The intrinsic value of the share is also known as real value of our business liquidation. In case the liquidation, it's a indicate of the company prospect value. For the company and market value for firms, liabilities and assets used, the assets value is calculated by subtraction that is accurately reflect the value of the company shares. It's very beneficial and very reliable. Third point is add value method. The percentage representing the return of the investment earned by investor who bought the company share. The value is under method is determined by comparing the sum investing by company owner to equal potential. The capitalization value is capital that the company has used to calculate the value of business. The shareholder yield is also used to calculate capitalization value for business. The capitalization value calculated using L received by the company's stockholder. And the fair value method, both and technique is the intersection value methodology are applied. The average of the intersection value and approaching to use to determine the firm's fair value. This method used to analysis to determine the value and fair level because the amount that was a retried average. The fair value technique has that name. Thank you.
Discounted cash flow. This determines the company's anticipated future cash flow from sale or other business activity. The present value of the future cash inflow is then calculated by the discounting them using the discounting rate. The discounting rate depends on the variety of the factor. The weighted average cost of the capital or the cost of the capital determined using the capital asset pricing would seem to be highly sensible. This theory is very useful for determining the value of private company or cash startup business. Multipliers. In this method, many multipliers are used to value of the company. These multipliers serve as the representation of the standard for the industry in which the organization is engaged. There are many different sorts of multipliers used, including earning multipliers, sales multipliers, and profit multipliers. Very useful tools for the estimating the worth of the startup and the private company. The capital structure two main elements are debt and equity. Dividends are paid to the investor while interest is paid to leaders. Leveraged business may benefit from the greater tax savings since interest is deductible. The value of the company is larger in the case of leverage grade corporation in that it is in the case of an unlevered organization since there is a bigger saving. The duration needed to repay the whole value of the initial investment is determined using the discount payback period approach. This method is more recent on that the computers that the discount value of cash inflow using the time value of money. Give that the present project has a discount payback period of the 4.03 years and the total life of 10 years. The project should be approved.
Next slide is internal rate of return. The percentage of return at which the project net present value is zero is known as the internal rate of return. This is often referred the project of break-even rate. This is used to be determined whether or not will be approved. The project must be accepted if the rate above the film cost capital. In the present instance, the IRR exceeds the cost of capital, hence the project is approved. Next one is net present value. This is the axis of the net present value over the value of amount invested in the project. The net present value is used time value of money for calculating the sum of presenting value of cash flow. This cash flow is discounted to the present value of calculating the net present value of the project. This cash flow is discounted to the present value of calculating the present value of the project. The positive net present value of the project is shows that the project is a viable, can be accepted, and if it is negative, the project shall not be selected. Next slide is profitability index. The profitability index, which is determined whether a film will deliver positive or negative net present value, is the ratio of net present value is initial invested. The NPV is a positive when the PI is a positive and negative when the PI is negative. The greater PI indicated the NPV is worth more. If the PI is positive in the instant and more than 2, the project will be approved.
Sensitivity analysis. The sensitivity of the NPV indicates that the project is 68.09% more sensitive if the running costs are just 25% of the sales income. Accordingly, the value of the net present value will be vary by 68% if the net operating cost is 25%. The NPV will change by 0.92 or 92.92% if the project's weighted average cost of capital is raised to 9.45%. The company's net present value would change by 0.97 or 97.40% if its tax rate was raised to 30%. Conclusion. Numerous value models are addressed in this study. This as a examined alternative business models for privately held and publicly traded companies. The Modigliani-Miller approach for the capital structure and firm appraisal is discussed in the paper. The decision-making procedure from capital budgeting are examined in this study. The analysis demonstrates that the project should be authorized independently of the different investment analysis techniques. Thank you.